Good morning and welcome. We're at the start of a critical week for markets as the FOMC meets this week. But before that, let me introduce my co-anchor to you. Ankita Saxena is with me. I'm Harsh Saita, and we're going to take you through all that's happening in global markets as well as what stocks to look out for over the course of the week as well as today. But more importantly, let's start off with how global markets are doing, especially it's been a longish weekend. Or a longer weekend, if I can call it, Ankita. So it's a tough Tuesday for us, but let's start off with how global markets are doing. Ankita, good morning.
Good morning to you, Harsh, and good morning, everyone. Yes, it is a tough day for us after the long weekend, but the US markets are pretty muted, Harsh, after the acquisition of First Republic by JPMorgan Chase. That was the big news that came out of US during the weekend. So yesterday, our US markets closed muted ahead of the two-day Fed policy, as Harsh mentioned, which is on the 4th of May, and we will be tracking that very closely. Stock futures as of now are slightly down. Nasdaq and Dow Jones both lost 0.1% in trade, and S&P 500 finished just slightly above its flat line. Now, also the US PMI data came out that pulled off a 3-year low in April. The ISM manufacturing PMI was at 47.1 versus the estimates of 46.6. Now, the big news that came in from the US market was, of course, JPMorgan Chase acquiring the First Republic Bank. JPMorgan Chase shares rose 2.1% after it emerged as the winner of a weekend auction for the First Republic. The big bank has acquired all of the troubled lender First Republic's deposits and a substantial majority of its assets. Now let's go across to the European markets. European stock markets closed higher as traders digested fresh economic data and more corporate earnings. The Eurozone economy grew by 0.1% in the first quarter of the year. Preliminary figures showed on Friday that the GDP numbers had come out on Friday, and even as Germany's GDP flatlined over the period. Now, a Reuters poll of the economists had forecast a quarterly growth of 0.2%. Now, the pan-European stock 600 closed more than 0.5% higher after dropping earlier in the session. DAX, CAC and FTSE were shut yesterday. That's the global handover. That's pretty muted handover that's coming in, Harsh, for the Tuesday morning.
Well, yes, absolutely, Ankita. So let's quickly take you all through events to watch as well. We have the FOMC rate decision later this week. We have the ECB rate decision as well on the 4th of May. So keep your eye out on both those decisions, which will affect global markets for sure. We're also looking at earnings, right? So we have within the global basket, we have Pfizer, Starbucks, Ford, Apple and Adidas all declaring earnings between the 2nd and the 5th of May. And we had Kotak Bank declare earnings on the 29th, and we have Tata Steel, Titan, HDFC Limited and Hero MotoCorp declaring their earnings between the 2nd and the 4th of May. So we have all of that within the corporate action basket. Among other corporate action, we have Home First Finance, which is going to consider a fundraise, and that's again today on the 2nd of May. We also have UCO Bank, which is going to consider a fundraise. So financials raising some money at this point of time. We have Godrej Properties as well as Awas Financiers. Again, both of those looking at a fundraise, but Symphony is looking at a buyback. So keep those two on your radar, but that is tomorrow on the 3rd of May. And of course, then on the 4th of May, we have the weekly expiry as well as Aptus Value looking to consider and approve raising of money again. So we have a slew of NBFCs as well as banks looking to raise money, and we have Symphony doing a buyback over the next 3 to 4 days. Keep an eye out on all of those names.
All right, Harsh, we will be keeping an eye out on all of that. But the biggest news that we were tracking over the weekend is what was the third major US bank to witness failure this year. California-based JPMorgan Chase will buy or has bought the First Republic Bank. The lender won the bidding to acquire the cash-strapped lender in an emergency government-led intervention. JPMorgan will take over First Republic's assets, including about $173 billion of loans and $30 billion of securities, as well as $92 billion in deposits.
Well, and switching over, the International Monetary Fund chief Kristalina Georgieva has said that the rapid acceleration in interest rates exposed vulnerabilities in the financial sector. She also added that the banking sector needs to be on the watch for additional risks. Industry leaders need to anticipate shocks and be ready to act when they occur because they will be coming, warns Georgieva.
And staying with macro concerns, the Berkshire Hathaway Vice Chairman Charlie Munger sounds an alarm, warns investors of serious challenges of the US property markets. Munger flags off bad loans in the US banking system, which are bound to flare up if property prices slide.
And in more worrying news, Morgan Stanley is preparing a fresh round of job cuts amid renewed focus on expenses as recession fears delay a rebound in deal making. Upper levels are discussing the elimination of as many as 3,000 jobs, amounting 5% of global workforce by the end of this quarter.
And with that, it's time for us to slip into a short break. Don't go anywhere. We go domestic after the break.
Welcome back. You're watching Market Cafe on ET Now. Let's quickly take you through what's happening in Asian markets. We did speak about how global markets are trending. Mild negative is what was coming through from global markets, but we're also looking at US futures, which are largely flat with a negative bias. Regardless of that, Asian markets are trading in the plus. They're trading in the green largely. We're seeing gains on the Nikkei. The Nikkei is up around 0.1% or so, as it will come on your screen, 0.5% in fact, so positive there. We're seeing the Kospi also gaining around 0.75% in trade. We're seeing gains on the Hang Seng as well as on the Shanghai, 1% plus gains posted by both indices, so that's again a positive. And the SX 200 is probably the only one trading slightly flat with a negative bias, down around 0.1% or so. That's where the Asian markets stand. The SGX Nifty itself is down marginally, down around 0.1%, is on the top of your screen. So we're looking at a mild negative, at least at the moment, at the start. And let's see how it plays out, because at least last week we saw 2 out of the 5 days where we started largely flat, but we ended well in the green. So hopefully that trend will play out this week as well, but have to wait and watch on that one. But one particular stock will be in focus today, and that will be Kotak Bank, because it's come out with its Q4 numbers and a very solid set that Kotak Bank has posted, much better than what was anticipated by most street analysts. We've seen net interest income grow a solid 37.5% on a year-on-year basis. It's come in 8% higher sequentially. NIMs continue to expand for Kotak. It's come in at 6,100 crore. We're also seeing operating profit and a very solid posting by Kotak on that particular count. And that is largely because OPEX was slightly lower than anticipated. So therefore, operating profit has grown a solid 21% sequentially, 42.5% on a year-on-year basis. It's come in at 4,647. The street was penciling in a number sub 4,000. So it's a very solid beat on that particular count. We're looking at provisioning, which was in Q3 at quite a low. We're seeing provisioning at, it was at 149 crore in Q3. We were expecting that number around 180 crore, see a slight bump up, but recoveries have been strong from Kotak, and therefore provisioning continues to be low, absolutely flat, 148 crore on a sequential basis, absolutely flat, and therefore the PAT has seen a solid bump. It's at 3,500 crore, which is a solid 30% year-on-year gain there in terms of the number. But we were penciling in a number of, or rather the street was penciling in a number of around 2,900 crores. So it's a very solid beat on that metric as well. Asset quality continued to improve, and that's a positive. Both GNPA and NPA ratios improved quite sharply. In terms of balance sheet growth, we did see advances grow a solid 18% year on year, deposits growth at around 16.5% a year, largely in line with what the street was penciling in. MSME is still the focus for Kotak Bank, and of course some very positive thoughts coming through on the banking sector as a whole from Uday Kotak as well. So that sums up how Kotak Bank or what the results really said about Kotak Bank and the banking sector.
Well, absolutely, Harsh. A big, strong beat coming in there on all accounts by Kotak Mahindra Bank. And on the back of that, we have two brokerage notes coming out for Kotak Mahindra Bank by CLSA and Morgan Stanley. But first up, CLSA. CLSA has downgraded Kotak Mahindra Bank to outperform from buy. Now, according to them, they have hiked the target price to 2,150 rupees per share from 2,080 rupees per share. Now, according to them, they see strong growth except the corporates. And they also see an improving retail deposit momentum that will be the key for growth going forward. They also feel that the CEO transition can be a bit of a can have a bit of an overhang there. So downgrade to outperform by CLSA, but Morgan Stanley has maintained an equal weight with the target price of 2,215 rupees per share on Kotak Mahindra Bank. They see this quarter to be, of course, very strong. The operating leverage has begun, according to them, and the loan growth, fee income and the NIMs have done pretty well, according to Morgan Stanley. Also, they feel that the earnings will be strong amid good macro environment for Kotak Mahindra Bank.
Right, we'll move ahead from Kotak Mahindra Bank. The government has collected a whopping 1.87 lakh crore as GST in April of this year, and this collection is now at an all-time high. The previous high being around 1.68 lakh crore. So that's a substantial margin with regard to the GST, the new high made. The previous record, 1.68 lakh crore collected in April of 2022. Prakash joins in with all of those details.
It's a big development coming in on GST front. As per the statement issued by the Ministry of Finance, GST collection numbers for the month of April recorded at 1.87 lakh crore, which is highest ever GST collection numbers. So it's a confirmation of our news break as well, as we had informed our viewers few days ago that the GST collection numbers in the month of April may break all previous records. As per the data issued by the Ministry of Finance, the previous highest ever GST collection number was at 1.67 lakh crore in the month of April 2022, but in the month of April 2023 it is more than 19,495 crore as compared to previous highest ever GST collection. When it comes to GST growth in GST revenues on year-on-year basis, it shows 12% growth than the previous year. When it comes to when it comes to e-way bill generation number, here too we can see a significant growth. It shows 9 crore e-way bill generation numbers in the month of March. So it shows that economic activities are growing in the country despite of all global challenges, and the GST number and the collection, highest ever GST collection number also shows that the impact of the GST Council decisions that has been taken time to time to make further simplification of the process can be visible in GST collection numbers as well. So we can only hope that the GST collection numbers may grow further on back of multiple reforms measures that has been taken by the GST Council, including simplification of the process of GSTN as well.
And well, it's that time of the month again when Street will be eyeing key sales figures from major auto names. Let's take a look at how several auto companies have performed in April. My colleague Sumit Chaturvedi joins in with more details.
Let's begin with the largest car maker in India, Maruti Suzuki. Its total sales have gone up 6.5%. Well, that's a good news coming from the dominant player of the market. Its total sales includes domestic sales, exports, and even to OEMs now. So all these figures have registered an increase, and that's why Maruti Suzuki's total sales have gone up by 6.5% in April. That happens to be the first financial month of the year. But there were some problems when it came to overall sales. The problems included shortage of components, electric components. So Maruti Suzuki said that shortage led to some kind of problem, and that's why the production was not as much as they wanted. Second big player, Tata Motors, and there the news was bad. Overall sales were down 4%. Commercial vehicle sales were down 4% as well. Tata Motors total sales were down 4% to 69599. Commercial sales were down 27% at 22492. PV, passenger vehicle, which includes cars and SUVs, those sales were up 13%. That's a relief coming from Tata Motors 47107 here. Eicher Motor, the motorcycle player, listed player again, its total sales were up 19% in April at 73,136 units. So in a way, a lot of Toyota Kirloskar, its sales were down. So it was a mixed bag when it came to the first financial month of the year. Going forward, we have to see how monsoon plays out, how interest rates are there, how rural demand is there, and that's what will decide what happens to other players in the auto market. So going forward, we have to keep a tab on all these factors that will determine how consumers buy their automobiles.
Right, eye on the auto pack. Thanks so much for that, Sumit. Let's quickly move on. Other big positive news for India is that the manufacturing PMI has hit a 4-month high in the month of April. The S&P Global India manufacturing PMI rose to 57.2 in April from 56.4 in the month of March, and all subcomponents of the PMI made a stronger contribution to this month's figure. With this, India's manufacturing industry has expanded at the fastest rate this calendar year. Both new orders and output both have grown at the fastest pace since December, while foreign demand also expanded at the fastest pace in 4 months in April.
And marking the second revision in prices in the last 1 month, oil and marketing companies have reduced commercial LPG prices by 171.5 rupees per cylinder. Now, the new rates would be effective from today. Meanwhile, the government has revised domestic natural gas price to 8.27 rupees per MMBTU. My colleague Prakash Priyadarshi joins in with more details.
Yes, some important development coming in from oil and gas sector, and the first one is with regard to domestic natural gas prices. Government has revised domestic natural gas prices at $8.27 per MMBTU for the month of May, which is effective from today to 31st May 2023. But as you are aware that under new gas pricing formula for APM gas, gas being produced from nominated fields of ONGC and OIL will have a ceiling at $6.5 per MMBTU, which clearly means that there are no such changes in APM gas prices for the month of May. Eventually, it is not going to burden consumer as well. So this is first such kind of monthly revision that has been taken by the Ministry of Petroleum under new gas pricing formula, which clearly says that APM gas prices will be determined based on 10% of the Indian crude basket prices. The second important development that is coming in with regard to LPG prices, oil marketing companies have reduced commercial LPG prices by approximately rupees 172 per cylinder. So new rates in Delhi will be rupees 1,856 rupees per cylinder. But it is important to note that there are no such relief for domestic LPG consumer. So they will have to pay the same amount they have been paying. So there are no such relief for domestic LPG consumer. Another factor that should be taken into account is that domestic LPG consumers are not getting any kind of subsidy from the government. Some kind of subsidy that is being provided to consumers from far-flung areas, not the LPG subsidy, that is transportation subsidy. The only customers which are getting subsidy from the government is Ujjwala customer, that is at rupees 200 per cylinder. So there is no such relief for domestic LPG consumers.
Well, thanks a lot for that, Prakash. We'll quickly move on. Max Healthcare Institute has lodged a suit against TPG, the owner of Care Hospitals, in the Bombay High Court after the private equity firm favored Blackstone's offer over Max's bid. The hearing is set to begin on the 3rd of May, and Max Healthcare is claiming breach of their term sheet agreement over a specific performance clause. Max Healthcare has also claimed that their own offer was shopped around to Blackstone despite a non-disclosure and exclusive agreement. The Max offer was said to be around 3,700 crore rupees and had an option to buy Care's Bangladesh assets after running them for 2 years.
And well, with that, it's time for us to slip into a short break. After the break, we get you more stock-specific action.
Right, welcome back. You're watching Market Cafe on ET Now. And it's raining exclusives here on ET Now on the back of that Economic Times Awards ceremony. Listen in to the biggest market and industry voices as they share their views on the India growth story and the road ahead. Let's hear out certain excerpts from the Finance Minister Nirmala Sitharaman and market honchos like Kumar Mangalam Birla, HUL Sanjeev Mehta and JSW Group's Sajjan Jindal.
If you go by the rule book, if all central banks are responding to the Fed's action almost sequentially, yes, and as a result you find Europe being more exposed to the chance of coming under recession. But I think since the last 1.5 years, gradually our central bank is also decoupling itself. Not that it was entirely linked with the US Fed even earlier, but post the pandemic and post the Russia-Ukraine, the sense that all central banks would look for a direction and move towards that direction sequentially is clearly disproved in the conduct of many emerging market central banks, not just India. So for India, I would think the contagion risk is not really a problem, but the risk is there in the sense when markets to which you largely exported are coming under recession, then the demand is going to fall, your exports are going to suffer. So that risk is definitely there. I'm not eliminating that. But the contagion risk usually linked to the conduct of the central banks, I would think is not there for us to face.
It's a very good time to be investing by corporate India. I think that so much has happened. NPAs are not there. Most corporates have delevered. The economy is onto a decadal 7 to 8%, 6 to 7 to 8%. That's huge for any large economy in the world. So I think that it's a perfect setting almost to be spending on capex and growing.
You're expanding all your businesses from paint to cement, even fashion, financial services. Given that we've seen a normalization in global growth and the sugar rush post-COVID is getting over, what's your view?
So I think, it has its impact, but at the end of the day, at least for us, we're building businesses for the long term. I don't think 1 quarter, 2 quarters, even a year matters as much. We are an integrated part of the global economy, India is. So you will have oil shocks, you will have commodity prices. So I think agility, risk management have become more important than ever before. And resilience, something that the COVID left us with.
I'm going to quote one of your comments that you have the right to win in the cement sector. And this comment came when after a big M&A happened in the cement sector. You still feel that you're committed in the cement sector, you have the right to win?
Absolutely, without a trace of doubt. We've been there for more than 40 years. Very deep roots across the country in the business. We understand the business very well. I think the repository of talent and knowledge is huge. So pretty much I stand by that.
You are now challenging the paint industry with that big capex which is coming via Grasim. Any of the other industry which you are looking at challenging now?
No, nothing really. We're also not challenging. We're not coming in from a challenger's mindset. We are making an investment that's complementary to our existing businesses. And that's how we are viewing it. If in turn it means that we're going to challenge incumbents, so be it. But that's not the driving factor. The driving factor, I think, is the fact that there is huge value creation opportunity for us.
Our top line growth was 16%, our volume growth was 5%, the price growth was about 11%. And if you look at the last quarter, against that 11% price growth, the price growth has come down to 7.5%. And going forward, the price growth is going to come down even more. Every company have their own strategy. As HUL, we will not acquire just because it is fashionable to do so. We look at it from a perspective that does it make a strategic sense for us? Is it a strategic fit? We also evaluate make versus buy. We also look at complementary positioning, the brand positioning, what are the skills the acquisition will bring to us, the capability, and also if the price is right.
Just the last word on rural consumption. We saw first-time tractor companies talking about strong numbers. We've seen a few unlisted companies talking about rural recovery. You're at the heart of it. What is the sense you get?
You know, the good bit is that the top line, headline growth is still there, which indicates that the consumers are spending more money. And if the consumers are spending more money, that's a very good sign.
So you are optimistic on rural recovery?
Oh, absolutely. I'm a born optimist, and we are clearly seeing green shoots. If the prices come down a bit more, the recovery will be even more faster.
It's not me personally, but the company is back the Corporate Citizen Awards, because company is the citizen, or corporate actually. So I played some role in it, but ultimately all the Mariconians have actually played a very critical role in making this happen.
Absolutely. Marico is the Corporate Citizen of the Year. Having said that, you know, your initiation into CSR as a company came long before actually CSR, you know, as a vertical was brought in and people were forced to get into CSR as a tick mark. Yeah. So talk to me about that and why you had the vision to look at CSR, you know, at such an early stage.
So you're absolutely right. You know, we started doing all this work 20 years back. We finalized a purpose statement, and that purpose statement was to make a difference to all the stakeholders. So since then, we've had detailed action plans in terms of how can we positively impact each and every stakeholder, and not just the shareholders. For example, what can we do extra for our customers? What can we do extra for the society? What can we do extra for our associates? And I'll just give you one example. You know, we buy a lot of copra. We are the largest copra buyer in the world, I reckon. And we have been working with 70,000 farmers in the state of Tamil Nadu. We are helping them improve their yields. We have a field force which goes to them, advises them in terms of best cropping practices, fertilizer, pesticides, whatnot. And we have seen consistently a 15% improvement in yields of coconut production, which if you value it, it comes to more than 100 crores extra benefit to farmers every year. So this is just one example, and similarly lots and lots of other initiatives we've taken to actually add value much beyond what we are expected to do. We are just, otherwise normally would buy coconuts, pay them money. But here we have gone one step ahead, and I think that's really helping us. It is helping us bond our relationship with all our stakeholders, and it's also giving us a great image. And more importantly, I think there's a very good feel-good factor within the organization that we are doing something for all the stakeholders. And this, as you rightly said, this happened much before the CSR 2% thing came in, because this happened 20 years back.
Give us a sense of how's corporate India feeling right now. Everybody's saying India is the shining star in the world. You're in the middle of all the action. Talk to us about it.
No, I think if you look at the whole world, US, Europe, Japan, other parts of the world, the whole world is kind of subdued at the moment. Inflation is running very high. Interest rates have gone up, so growth rates are very low, GDP growth. So, you know, in this whole situation, India is really emerging out to be the real bright star, because we are growing well, we're doing well, our inflation is well under control, very well managed, COVID was managed extremely well. So I think that the whole the management has been extremely good, and that's why everybody is bullish.
Jindal, we can see that all your businesses are firing in all cylinders. Where are you putting maximum of your mind share and time these days?
Well, the whole world is going through this energy transition. That's a very big thing that the whole world is passing through. And at JSW Group, we are also working towards looking at energy transition, how we can make steel more energy efficient, how can we make more and more renewable power for the country. So that's where the focus is.
We also read about your interest in new mobility, EV-related mobility. How are the strides the team is making in that side?
That's also part of the whole strategy, because I believe that there is a big
opportunity there because that's the way the new mobility would be all electric or all environmental friendly. So I think there's a big opportunity, and that's the whole idea.
And you are looking at some stuff there?
We are working on it.
Okay, one last word. You know, McKinsey says that this is going to be India's century. Every other day on the Economic Times front page, we see some big global company coming and talking about their India plans. You also interact with global business leaders along as part of your business and otherwise too. What is the sense you're getting from your interactions with global business leaders regarding India runway on a decadal basis?
No, clearly India is the flavor of the decade, at least, if I don't say for the century, because it's too long a period, but for the decade, because for so many factors, and also friendly shoring is the new buzzword where everybody wants to do business with a country which is not controversial, which is not creating any problems. So that's how India attracts the limelight in the world, and everybody wants to invest in this country. It's a big market. Home market is very large. Plus it's now demographically it's the largest populated
Just
country.
One last question.
So,
out of all your businesses, some are legacy businesses like commodity and all. Of course, you're doing value addition there. Some businesses you have scaled up in the last 3-4 years, which are very forward-looking and futuristic in nature. How do you see promise in each of those segments?
well, all our businesses are very interesting and are very future-proofed, as well as looking at domestic demand, India's requirements. Our businesses grow as per that. We are more focused on domestic while we continue to export our products, but domestic market remains our major focus area.
The demand is now coming back very, very strong. Economic indicators are strong. Private demand will follow.
Okay, so do you think that companies will increase their capex in this financial year?
See, you can clearly see the momentum in the country.
Okay.
And with momentum, everything will come. I feel that, credit under-penetration is so much in the country. Credit demand is now strong. Formalization of economy is happening. Formalization.
Yes, sir. Yes,
That's
sir.
all very big factors.
Okay, so you said credit demand is there, formalization is happening. So which sector you are looking on that we will see boost going ahead? Which particular 3 sectors do you think?
See, if you see the Credit Bureau data from CIBIL, you will clearly see that the small micro entrepreneur credit is the fastest growing credit segment in the country, the fastest.
Okay.
Not the large corporate, not the mid corporate, not the small, micro is the fastest growing.
Okay.
Why it's happening? Because because of so much of digitization happening. Earlier, those people could not prove their income. Now they can prove the income.
Okay.
So this is a very big factor coming up. It's good for India also.
So, but for that micro level, the ticket size would be small. So, do you think that volume can become big?
No. Listen, not about. It's about credit not being available. Now it's available. Automatically, their prospects will go up. It's not about ticket size and all. India will grow.
Okay. So, after that, you're saying that formalization. So, as a banker, sir, do you think, or at least in your bank, that due diligence has increased?
Naturally, because systems have improved. Now not that you have to do. Now data post source available. That's very well-known story.
Okay.
I feel that that the NPA improvement in the country that you're seeing across all banks, I feel it's a structural story. It's not a cyclical story. Of course, some portion should be cyclical, but substantially structural story. I mean, it will stay for a while.
Back, you're watching Market Cafe on ET Now. Let's quickly take you through what's happening in the oil markets. The oil prices have dropped slightly ahead of that critical US FOMC meet. 25 basis points is what's expected in terms of a rate hike, and that is really triggering some slowdown concerns, which is weighing down on oil prices. Let me try and also break down the other piece in play. The other piece is the dollar index. The dollar index continues to strengthen, and as that plays out, oil prices fall because there is an inverse relationship between the two. So as the dollar index starts to rise, oil prices start to fall. So they are well below that $80 a barrel mark where it was at the start of the last month now. April is now firmly behind us. So, a solid 5% decline through April, and now we're at the start of May. Roughly at $75.50 a barrel WTI, that's where it's at. And where Brent is concerned, Brent is at $79 a barrel. That's where we're at.
Well, all right, then it is that time of the show where we get you all the stock specific action and tell you what are the stocks that you need to keep on your radar for the trading session. And for that, we have Lisa in the studio with us. Lisa, tell us, what are the stocks that have caught your eye?
Yes, good morning. Firstly, let's start with the earnings which were reported. RBL Bank has reported its earning with the net interest income that was up 7% on year-on-year basis and stood at 1,211 crore. The operating profit was, however, down by 10% year-on-year. Moving on to IDBI Bank, the net interest income that was up 35% year-on-year, while the operating profit that was up 60% year-on-year. And also M&M Financial that reported its earnings where the interest income was up 20.2% while the NIIs was up 7.6%. So quite a mixed set of earnings coming for the financial stocks. Also Vedant Fashions has reported its earning where the revenue was up 15% on year-on-year basis while the EBITDA was up 17%. Now moving on to the non-earning announcement where NMDC they have cut the iron ore as well as the lump ore prices by rupees 100 and 300 respectively. Well, analyst says that the price cut that was in line with the expected range on account of the falling prices in the international market. Also, Axis Bank Board has approved the appointment of Subrat Mohanty as a whole-time director and he'll be designated as the executive director of the bank. RVNL also has emerged and will be in focus. It has emerged as the lowest bidder for Chennai Metro Rail project and the project is worth around 1,134 crore. So well, these are the stocks that will be on investors' radar for today.
Well, thanks so much for that, Lisa. The other stock that's going to be on investor radar is Tata Steel. It'll be in focus ahead of its Q4 numbers today. Ashesha joins in with what the street is expecting.
We are expecting sequentially strong set of numbers from Tata Steel this time around. India operations will continue to report strong set of numbers, while Tata Steel Europe operations could continue to disappoint this quarter, which could limit the upside as far as their consolidated numbers are concerned. Let's talk about numbers now, where consolidated revenues are expected to see an uptick of about 5% on a quarter-on-quarter basis. Margins, meanwhile, are expected to expand. We are expecting margins to come in at 9.3% versus 7.1% margins that the company had reported in the previous quarter, indicating an expansion of nearly 220 basis points on a quarter-on-quarter basis. Let's talk about India operations first. Volumes and realizations are expected to see an uptick. Volumes are expected to expand by about 8% on a sequential basis, while realizations are expected to see an uptick of about 3% on a quarter-on-quarter basis. Consequently, EBITDA per ton is expected to come in at 14,000 rupees per ton versus 11,350 rupees per ton that the company had reported in the previous quarter. Let's also talk about European operations then. Weak demand will continue to hamper European operations this time. EBITDA per ton of European operations are expected to come in at negative $105 per ton versus negative $95 per ton that the company had reported in the previous quarter. Key monitorables include debt reduction plan of the company, support for its UK business, as well as contract repricing that will be done by the company in its Europe operations. All in all, strong set of numbers expected, but European operations will continue to disappoint this quarter as well.
Thank you for those details, Ashesha. And moving on, QSR stocks such as Devyani International, Sapphire Foods and Westlife are in focus as Goldman Sachs has initiated coverage on these stocks. My colleague Winnie is here with all the details of these brokerages. Over to you, Winnie.
So Goldman Sachs, what they are saying coming in specifically on the QSR space, they believe there's a lot of opportunity here. It's one of the most attractive opportunities in Indian consumer side as well. And that is why they're positive overall on the QSR space. They've initiated coverage on Devyani International with a buy rating and target price of 200 rupees per share. Sapphire Food also they're initiating with a buy rating and a target price of 1,700 rupees per share. While in terms of Westlife Development, they've initiated coverage with a neutral rating and a target price of 790 rupees per share. They're neutral on Westlife Development mainly because they believe that owing to the stretch valuations already for Westlife Development. Other than that, they believe that there's a QSR market has a large headroom for growth. There are many drivers for growth coming in for the QSR space, and the recent 15 to 20% correction in the QSR stock has created a very attractive valuation and value opportunity for them as well. And that is why they're positive on Devyani as well as Sapphire Foods, while neutral rating is what they're coming in with for Westlife Development.
Right, thanks so much for that, Vinny. Let's quickly move on. Vamakshi is here. She's going through all the brokerage notes for us, as she always does. Vamakshi, which are the key notes to look out for?
Well, absolutely. Let's first start off with M&M Financial Services. We have a note that came in from CLSA. Now the company did report its Q4 numbers, and CLSA believes that the focus area this time around was the asset quality for the counter. Anisha could not have emphasized on it more, that we're seeing some very sharp improvement as far as the asset quality is concerned. However, the only disappointment that came in for M&M Finance this time around was the higher OPEX as the company invests in IT and other platforms. So on the back of all these factors, M&M is CLSA's top pick in the sector. They've maintained a buy, hiked their target price from 310 to 330 per share. SBI Cards is the next one on our radar. We have two notes that have come in, one from Morgan Stanley, the other from CLSA, and both these counters have actually hiked their target price on SBI Cards. Morgan Stanley has hiked its target price to 965 from 925 earlier, while CLSA has hiked its target price from 750 earlier to 800 per share. Morgan Stanley is maintaining an overweight call, while CLSA has maintained an underperform call. CLSA believes that the spending growth is healthy, but the revolver share is not improving. OPEX and credit costs were slightly higher than what they were expecting, but they are largely unfazed. Morgan Stanley, however, they believe that the Q4 numbers were 10% above estimates. Asset quality, however, was marginally weak in their opinion, and they also believe that the cost of funds is also likely reducing. Apart from that, lastly, we will be watching out for Indian hotels. We have a note that is coming in from Jefferies, and they're highlighting that they're seeing incremental demand drivers for FY24, ARRs settling at higher levels. They're also seeing that the company is diversifying its top line, and asset-light growth are some of the key focus areas. So given all these factors, Jefferies has maintained a buy on Indian hotels and also hiked its target price from 380 to 405 per share.
All right, then thank you so much for that. Moving on, Canada's Brookfield Asset Management has acquired a 51% controlling stake in Rostrum Realty, a real estate joint venture company in which Sunil Mittal-led Bharti Enterprises will hold the remaining 49%. Now, Rostrum Realty houses 4 upscale commercial properties near the Delhi airport and in Gurgaon and Ludhiana. The transaction was based on an enterprise value of 5,000 crore rupees.
Right, and Purinj Vilayat, MD and Portfolio Manager, Equity Intelligence India, believes that the pharma sector offers value, but advises to be selective. He's cautious on the new age tech sector, and let's quickly go and listen in to what he had to say.
See, the pharma is something we recently talked about. It is already moving. Pharma has been beaten down for a while, and sell-off, I think it's all over. And there are very steady, stable pharma companies, I think, which are very attractively priced. And some of them have gone up by recently maybe 20, 30, 40% after decades of depression. I feel pharma is a sector to look at, but should be very selective. To be frank, for me, it's very difficult to make a comment on Paytm or the Nykas of the world. They all are very most modern businesses. So the valuations depends on, it's all in the each person is different. It's different. We can't generalize that. I do not fully understand those business models and the potential cash flows. I still feel some of them are overpriced. It may not move. There could be some of them could be great business models, and it is going to be sustainable. They are going to will be there for the next 5-10 years as a business model. But those stock prices it may not reward. It may not go up for the next 5 or 10 years.
Well, with that, we are completely out of time on this one. So Harsh and I will take your leave. Thank you so much for tuning in. Don't go anywhere. The markets will take the action forward.